Let's talk in depth about those minutes out of the most recent BOE meeting with our next guest, who is a former BOE economist and former economic advisor to the government. He's Danny Gabay, currently managing director at Fathom Financial Consulting. Danny, welcome this morning. BOE growth saying growth will be slower for longer, saying inflation is going to be persistent. No real surprises there, but should they be doing a little bit more?
There's a minor surprise. I think there was some, and I think that's why sterling has risen, some expectation that maybe a couple of members or maybe more might have started to look towards actually easing policy further, and the fact that they haven't has supported sterling. The economy is at a turning point. It looks like the momentum that we had going into the second quarter has faded quite quickly. And the problem with inflation is that you have to let bygones be bygones. Inflation is high, but they've got to look forward. And looking forward, it looks like it should moderate.
Are we talking about this slowdown really coming from external forces, coming from the global slowdown? What we're seeing, this is really before we've seen what happens with the austerity cuts. Certainly
the slowdown outside of the UK is not helping the situation. There would have been a slowdown anyway, as you say, because of the austerity measures. The fact that we're seeing activity ease from China to America, and even though the second quarter was very strong in Europe, the indications are that demand in Europe remains relatively weak. All of that adds up to a pretty soggy second half of the year for the UK.
Now, George Osborne has been defending the stringent budget cuts. We still don't know the details of them, but he was talking about that yesterday. The Monetary Policy Committee says that they will have a marginal impact. Is that... I mean, some of these cuts are huge. We're talking about possibly 600,000 job losses. Is that marginal?
Yeah, I was quite surprised by that. I mean, you know, I understand the logic of the MPC's position that by putting in place a credible plan, the Chancellor has averted what was, and I agree with him, a much bigger risk, which was that the markets would lose faith, sterling would fall sharply, and force the Bank of England to raise rates when they didn't want to. But I wouldn't call the kind of austerity measures that the Chancellor's outlined, which are going to be the most stringent since the Second World War in this country, as marginal. They are going to have a quite meaningful impact in the short term, at least. And the hope is that the private sector will make up the loss of the public sector, but Indeed. It's a hope. Well, it is a hope, yes. I mean, it does seem as if that's almost set in stone. We're hearing George Osborne saying that those jobs will be mopped up by the private sector. We don't really know yet if that's going to happen, do we? No, but history is on his side, actually. We looked at 3 different episodes in the 1990s, Canada, Sweden and the UK, and in each case, fiscal tightening did lead to a substantial loss of public sector jobs, but in each case, total employment did rise. And if we look at just the UK, in the mid to late 1990s, we lost about 650,000 jobs in the public sector, but gained overall just over 2 million jobs. So 2.6 million private sector jobs were created. That's not to say history will repeat itself, but you know, it does tend to rhyme. And just before you go, the housing market, we are seeing that some downward pressure on the market. Does that concern you? No, I mean, it's to be expected, I think. I think most of us were scratching our heads for the most of last year as to why the housing market was rebounding at all. Right. So it makes a bit more sense now, given the jobs market and given the weakness in demand. And, you know, hopefully the housing market will continue to deflate in a very gradual manner, which will eventually allow people who are currently locked out of the market back in. Okay. Danny Gabay, thank you very much indeed for your analysis this morning.